You are listening to Chapter 1, Lesson 6 of Form 4 Economics. Cameroon General Education. Narrated by Wacheseh Academy. The capital structure of a company. The capital structure of a company can be classified into the following. 1. Authorized, nominal, capital. It is the maximum capital with which the law permits the company to raise capital through the issue of ordinary shares, preference shares, and debentures. It is always stated in the Memorandum of Association. 2. Issued capital or called-up capital. It is part of the authorized capital issued to the public for subscription. 3. Paid-up capital. It is the amount of capital actually contributed by the shareholders to the company. Shares. Shares are amounts of money contributed by shareholders into a company in order to become shareholders and have a right over the profits of the company. Every shareholder is given a share certificate, which is a document issued under an official seal of a company showing ownership of shares in that company. Types of shares. 1. Ordinary shares, equity shares. They are also known as equities because they receive equal amounts of dividends. The ordinary shareholders are the real owners of the business. They bear the greatest risk and receive their dividends after debenture holders and preference shareholders. They can vote and be voted for. They have no fixed rate of dividends, and this is the most profitable type of investment. It is also the riskiest form of investment in a public company. 2. Preference shares. A preference share is a type of share which has priority in terms of dividend payment and repayment of capital in the event of ending up. They have a fixed rate of dividend. They are 3 types. Namely, cumulative preference shares, participating preference shares, and redeemable preference shares. 3. A debenture is a loan to a company and not a share. It is a debt on the company. Debentures carry a fixed rate of interest, and their owners are promised repayment of their loan and interest on a particular date. Debenture holders are not part of the company, they are creditors to the company. When a company needs long-term capital, it obtains it through the issue of debentures from the public. There are 2 types of debentures, namely, mortgage debentures and floating debentures. They are bought by people who want a very safe investment, those who fear risk. Differences between shares and debentures. The following are the differences that exist between debentures and shares. Persons who buy shares are the owners of the company while debenture holders are creditors to the company. A debenture represents a certificate of indebtedness, whereas a share is a unit of capital. Shareholders receive dividends whereas debenture holders receive interest. The dividends shareholders receive depends largely on how much profit the company has made, whereas a debenture shareholder is entitled to a fixed rate of interest whether profits are made or not. Shareholders are the risk bearers of the company while debenture holders are not. Ordinary shareholders have voting rights in the company while debenture holders do not have any voting rights. In the event that the company winds up, or liquidates or closes down, the debenture shareholders are paid first before the shareholders. Importance of stocks and shares to a business enterprise. Stocks and shares are necessary to a business enterprise for the following reasons. They are a source of initial capital to new companies. Existing companies that want to expand can obtain more capital through stocks and shares. They appeal to different classes of investors. They make investment liquid, that is, investors who no longer want stocks or shares can easily sell them to the stock exchange market and get their money and use for other purposes. So money is not tied unnecessarily on investment. People can therefore invest in them without fear.